Welcome to my channel, Brands Investment Insight. In this video, I will briefly discuss today's economic conditions and also the 1980s Great Inflation, how the Fed in the 1980s fight inflation and when did Fed change its policy. We will learn from history and apply those lessons to today's investment. The US economy avoided a recession in 2022 because of, shockingly, resilient consumers. Gross domestic product rose at a 2.9% annualized rate in the fourth quarter, the Bureau of Economic Analysis reported Thursday. That's a slight slowdown from the 3.2% GDP growth seen in the third quarter, but still well above FactSet consensus expectations for 2.3%. In the meantime, the Fed Reserve is still hiking the interest rate to fight inflation. But inflation is showing signs of slowing down. From this chart, the inflation is showing signs of slowing down and the market expects the Fed to pause or pivot, that is to change the monetary policy to support growth. How should we position ourselves in this market condition? Maybe we can learn something from the Great Inflation period in the 1980s. Paul Volcker, as the chairman of the Federal Reserve in the early 1980s, implemented a series of monetary policy measures aimed at reducing inflation. At the time, inflation was running at a high rate and was considered a major economic problem. To combat inflation, Volcker raised interest rates dramatically, which made borrowing more expensive and helped to slow down economic growth. This tight monetary policy, combined with other factors, contributed to the end of the inflationary spiral and helped to restore price stability. Only by 1982, the inflation is showing signs of going down. In 1982, the United States was facing a number of economic challenges. The economy was still in the aftermath of a severe recession that had started in 1981, and the unemployment rate was high, with many Americans out of work. In addition to these problems, the country was grappling with high levels of debt, both at the household and government level, and a weak housing market. The manufacturing sector was also facing significant headwinds, with many industries facing competition from overseas and declining profits. The rate of inflation had started to decline, however Volcker continued to fight inflation. In the 20th of July 1982, Paul A. Volcker, the chairman of the Federal Reserve, said that the nation's central bank would stick to its relatively tight monetary targets for this year despite the continuing slump of the economy and the strains on the nation's financial markets. But Mr. Volcker, in a break with past policy, said that the Fed had tentatively decided not to tighten the money supply growth rate next year, a move that would allow the Fed some flexibility in helping a recovery continue into next year. Mr. Volcker outlined his monetary targets for the rest of this year and next as he presented the Fed's mid-year review of policy to the Senate Banking Committee. Although short-term interest rates have declined in the last 2 weeks, analysts did not interpret the Fed's announcement, especially the higher-than-expected tentative target for 1983, as a major change in the Fed's overall tough anti-inflation policy. In today's context, this is a Fed pause. However, the stock market was still disappointed, and sold off immediately after his comments. With inflation continued to fall, in 1982 October 10, Fed changes its stance. On October 10, 1982, Paul Volcker, chairman of the Federal Reserve Board, said today that he considered inflation under control and that he now wanted to help try to pull the economy out of the recession. The forces are there that would push the economy toward recovery, Mr. Volcker said in a speech to the Business Council, an association of current and former heads of the nation's largest corporations. I would think that the policy objective should be to sustain that recovery. This is a huge Fed pivoting within 3 months. The stock market reaction to Paul Volcker's speech was very positive. After several years of high inflation, slow growth, and uncertainty about the future, the speech was seen as a sign that the worst was over and that the economy was finally starting to recover. The stock market, which had been performing poorly in the preceding months, rallied in response to Volcker's remarks, with the Dow Jones Industrial Average posting strong gains. Investors were encouraged by Volcker's comments on the declining rate of inflation and the improving outlook for the economy. They also appreciated his reassurance that the Federal Reserve was committed to maintaining price stability and that it would continue to support the economic recovery. There are many takeaways from this historical event that can be applied to today, which has big implication to our investment. 1. Fed changed policy in less than 3 months, from sticking to a tight target to shifting tactics. Therefore today the Fed is also data dependent and may change policy quickly if data support the change. 2. The 1982 stock market price fell almost entirely as a result of the valuation drop, indicating that earnings were actually resilient despite high inflation. Today the S&P 500 index valuation is actually quite resilient as well, with most of last year's drop coming from the multiple contractions. 3. In 1982, the economy was in a recession, and the PMI was below 40. Today, the PMI is above 45. This is the main difference here. Today we don't have a recession yet. 3. After the Fed decided to pause and remain tight in July 1982, the stock market continued to fall another 8%. However, the stock market rallied by around 25% from the low point to October 1982 to anticipate the Fed pivoting, as inflation continued to fall. Today investors should also focus on the inflation trend. If the inflation trend continues to go down, this is very bullish on stocks as the Fed will have to pivot. 4. Within 2 months of the Fed pivot, the market reached an all-time high. This shows how fast the market reacts to the Fed policy change. Today if we hear that the Fed will change policy, we should quickly buy stocks as long as the economic conditions are still stable. 5. Following the Fed's pivot, the stock market rallied for another year by around 40%, but with higher volatility. The rally came mainly from valuation expansion. 6. By 1984 earnings improved, the bull market resumed and valuation declined as earning improved. With all those historical observations, with inflation continuing to trend down, I believe the outlook for economic growth will also be improved, and the stock market will sustain a strong recovery soon. Thank you for watching and please subscribe to my channel for more videos like this.